Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the best Canadian dividend stocks for DRIPs. These stocks pay a high dividend and they're very easy to qualify for a DRIP, a Dividend Reinvestment Plan. A DRIP allows you to automatically reinvest your dividends to earn extra shares for free every quarter or every month, letting your stocks grow on autopilot. I've never made a video quite like this. I love dividend stocks, and I always mention the benefits of DRIPs for that long-term exponential growth. But in this video, I'm only talking about stocks that have easy DRIP thresholds. In fact, you'll only need $2,500 or less for each of these stocks. But let's be clear, you should never invest in a stock just because it's easy to get a DRIP. The same way you shouldn't buy a stock just for its high dividend. They have to be sustainable. These are all quality companies that I've been investing in for years because they have a long-term future. I'm not buying them just for the DRIP. I'm holding onto them for life to get reliable passive income and capital appreciation. The DRIP is just a bonus. I've already made a whole video illustrating the power of DRIPs with real life examples and how to set it up, so check that out. But as a quick recap, a DRIP is when you automatically reinvest your dividends to buy new shares rather than receiving cash. So to qualify for a DRIP, you have to own enough shares so that the dividend you receive is larger than the current share price. The stocks on this list pay a high dividend and they have a relatively cheap share price. That's why it's easy to unlock a DRIP. Compare this to an expensive stock like TD. Don't get me wrong, I love TD. It's one of my favorite stocks of all time, but it costs almost $100 per share. So to get a DRIP to buy that extra share, you'll need about $10,000 invested, which is not easy. That's the point of this video. For all of these stocks, you'll only need $2,500 or less to lock in that DRIP and enjoy that automatic growth. So let's jump in. Starting with one of my favorite dividend stocks, Manulife Financial, ticker symbol MFC.TO. I've already talked about Manulife several times on this channel, but really quick, Manulife is among the 20 largest companies in Canada, and it's the largest insurance company here, but it's so much more than just insurance. Like the big banks, it's one of the oldest and most established financial institutions. It's been here for over 130 years, so it's seen it all: world wars, recessions, depressions, and they're still here. That's because their services and products are always in demand. In terms of insurance, they offer everything: health insurance, life insurance, travel, mortgage insurance, and more. But they also offer bank accounts, mortgages, credit cards, GICs, loans, and investing through mutual funds. They're also diversified geographically with over 30 million customers worldwide. Manulife has a strong presence in the US, but they are even more successful in the Asian market. With the rising middle class in Asia, wealth management and insurance products are in huge demand. In fact, Manulife now makes more money in Asia than they do in Canada, and they'll continue to expand. Because of these consistent profits, they've always been able to pay a great dividend. Right now, their dividend yield is 5.1% paid out quarterly. Not only is this a high dividend, but it's sustainable because of its extremely low payout ratio of 35%, which is amazing. That means only 35% of its profits go out to investors through dividends, leaving it with 65% of its net income to reinvest in itself and grow as a company. Because of this super low payout ratio, Manulife's dividend is very secure, and we can expect a dividend raise later this year. So why am I putting Manulife on this list? Because it's very easy to lock in a DRIP. You'll only need about $2,100 to qualify. Let's go through the math. With a dividend yield of 5.1%, our $2,100 investment would give us $107.10 per year in dividends, or $26.77 per quarter. Manulife currently has a share price of $26.20, so every 3 months, our dividend will allow us to purchase an extra share of Manulife for free, and then we receive the remaining 57 cents as cash. Looking at my Excel dividend tracker, you can see that every quarter, I'm earning 2 and sometimes 3 shares from DRIPs in my TFSA account and another 2 shares in my margin account, and it didn't take a lot of money to get there. That's because I invested heavily in Manulife at the low point, during the massive market crash in March 2020, but Manulife was able to fully recover and I was rewarded with great capital gains. Since 2022, we've seen some turbulence with the market downturn, but I've been investing throughout, and my DRIPs have been buying more shares on autopilot, earning me reliable and increasing passive income along the way. If you're not sure how to actually buy these stocks, click the pop-up to watch my Questrade tutorial, where I give a step-by-step walkthrough of how to buy stocks using Questrade, my favorite online broker. You can also use Wealthsimple Trade, but they do not allow drips. It's one of the many limitations of Wealthsimple. But with Questrade, drips are super easy to set up for any stock or ETF. So if you'd like to get started with Questrade, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. Next up, let's look at the real estate sector with one of the lesser known REITs in Canada called Plaza Retail, ticker symbol PLZ.UN.TO. A REIT is a real estate investment trust. This is a collection of hundreds of real estate properties packaged together as a stock. And the rent from all of these properties goes back to investors as dividends or distributions. They're basically a way to tap into the real estate market through the stock market, so you don't need $100 grand for a down payment. Plaza is a retail REIT, so their properties are shopping centers, and the individual stores are their tenants who pay them rent. I've talked about the biggest retail REITs in past videos, like RioCan, H&R, and Smart Centers, but those are all large cap companies worth billions of dollars. Plaza is significantly smaller, with a market cap of about $500 million, so it's definitely less established and potentially on the riskier side, but there is room for growth. Like Smart Centers, Plaza REIT avoids indoor shopping malls, instead focusing on open-air shopping plazas and multi-tenant strips, which make up about 96% of their portfolio. And the majority of their tenants are essential businesses, like groceries and pharmacies. This is good news. If we ever have another lockdown, these open-air centers and essential stores will remain open and continue to pay rent. But unlike the big players, Plaza avoids the expensive markets like Toronto and Montreal, instead focusing on value properties and redevelopments to build equity and attract quality tenants. And that's the key. By getting quality tenants, Plaza REIT has a 97% occupancy rate, and 91% of their tenants are Canadian retailers. So they rent out to consumer staples like Shoppers Drug Mart, Loblaws, Dollarama, Sobeys, Tim Hortons, Winners, Good Life, Canadian Tire, and some American stores like KFC, Staples, and Best Buy. Like most retail REITs, Plaza pays out a massive dividend with a yield of 6.15%, and this dividend is paid monthly. As I always say, a high yield is not enough. It needs to be sustainable. When it comes to REITs, we don't use the payout ratio from net income since that doesn't account for the depreciation of its properties. For REITs, we look at the funds from operations, or FFO instead. As I talk about in this video, the FFO is much more representative of the true cash flow of the business. For Plaza REIT, they have an FFO payout ratio of 69%, which is really good for a retail REIT. That means that only 69% of its income from regular business activities goes out to investors as dividends or distributions, leaving the rest to buy more properties and expand. Many REITs have an FFO ratio above 90%, so even though this dividend is quite high, it is sustainable, and that's what matters. My favorite thing about Plaza REIT is its drip. It only takes $900 to lock in a drip, and this is a monthly drip. That's because of its high dividend, but more importantly, because of its low share price, less than $5. Out of all the stocks I own, Plaza REIT is the easiest drip by far. Looking at my dividend tracker, you can see that I'm earning 5 or 6 shares every month for free. That's 72 extra shares a year, totally on autopilot, and I love it. So with $900 invested and a yield of 6.15%, we'll earn $55.35 a year in dividends or $461 a month. The share price is only $4.57 right now, so that's enough to buy an extra share every single month. Looking at the stock price over the past 3 years, you can see the massive crash in March 2020, but it was able to recover in a matter of months. Now with rising interest rates in April, we've seen the overall market take a drop, especially the real estate market. But as long as REITs like Plaza maintain those quality tenants to pay out consistent rent, they will recover and continue to pay out that great passive income along the way. I've shown you a quick peek of my TFSA portfolio, but if you want to see my full portfolio and to help support my channel, hit that join button down below to gain access to my exclusive videos like my TFSA and RRSP portfolio reveal and to see what stocks I'm buying every month. This membership program will cost $5 a month or about $1 a week. It definitely helps keep me running, but don't feel pressured to join. Watching my videos and leaving a comment and a thumbs up is more than enough. But if you do want to help out and see more of my content, I do appreciate it. And at number 3, we have Telus, ticker symbol T.TO. Make sure you include the .TO. If you only search for T, you'll probably get the American company AT&T. Telus is one of the 3 telecom giants in Canada, and so their products and services are always in demand. Even in a recession, people and businesses need their phones and internet, so they are always profitable. We've seen this over the past decade. Telus has grown their revenue every single year, even through the pandemic. That reliable income allows them to pay out a generous dividend of 4.95%, paid out every quarter. They actually increased their dividend twice last year, back in June and recently in December, for a total raise of 7.3%, which is great to see. In fact, they've increased their dividend every single year for 18 years straight. And to keep it going, Telus has committed to increasing their dividend twice every year until 2025. This aggressive dividend growth is great for passive income, but it does come with a larger payout ratio of 90%. This means that most of its earnings are going out to investors. This isn't the best news, but it's actually in line with the rest of the telecom industry. And it's significantly lower than their biggest competitor, Bell, with a payout ratio of 120%. The telecom companies are investing tons of money to expand their infrastructure and 5G capabilities. And with rising interest rates, this does cost more, but it should pay off with future earnings. Again, with these high interest rates, we are seeing a dip in the price of Telus, but it does make it easier to qualify for a DRIP. Right now, you only need $2,300 to lock in a DRIP with Telus. With $2,300 invested and a yield of 4.95%, we'll earn $113 a year in dividends or $28.46 per quarter. The share price is only $28.35, so that's enough for a free share every 3 months. Looking at my Telus holdings, I'm earning 1 share from DRIPs every quarter in my TFSA account and 2 shares in my margin account. Looking at the stock price over the past year, you'll see a steady drop since April 2022, when the interest rates started shooting up. But if we zoom out to 5 years, we get a different picture. We can see a clear upward trend, fueled by the consistent and growing revenue of the company. We saw a big drop in the market crash of March 2020, but it was able to recover quickly. And once interest rates steady and start to come back down, I expect another quick recovery. In the meantime, I'll be collecting that passive income and those DRIPs every 3 months. To actually buy these stocks and to lock in those DRIPs, click my referral link down below to sign up with Questrade, my favorite online broker, and use my code Canadian T-shirt to get that $50 sign up bonus, and you'll help support my channel. I'll also include my link below for Wealthsimple Trade, which is a great platform for Canadians, but remember, they don't support DRIPs. So there you have it. Those are my 3 favorite dividend stocks for easy DRIPs. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel here on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.